This is the seventh exercise from our workshop, topic one, and it deals with the allowance for uncollectible accounts and bad debt expense. In this problem, we have a company that sells to its customers on credit. They give 30 days credit. They have to use the allowance method. They can reasonably estimate the amount of bad debt that they're going to incur in the course of business. This allows them to recognize revenue at the time that the sale is made. The company issues interim financial reports throughout the year. They have chosen for their interim reporting to use an income statement approach to determine the bad debt expense for the period that they're reporting on. And they do this by taking the credit sales for the period and multiplying it by 2%. Now, at the end of the year, for the annual reporting, they use an accounts receivable aging schedule to adjust the balance in the allowance for doubtful accounts and to make a final adjustment on the bad debt expense. And this is perfectly fine under GAAP. In fact, many auditors will independently determine what an acceptable allowance should be based on something different than the company may do. So it's kind of looking at it from different perspectives. So this hybrid approach is quite common. We're presented with the activity in the accounts receivable accounts for the year 2012. They tell us the beginning balance, the amount of credit sales, the collections, and the write-offs. Beginning balance plus the sales minus the collections minus write-offs gives us an ending balance of $1,223,000. At the end of the period, the controller runs an accounts receivable aging that groups the accounts receivable into 4 different categories, as you see here, and the total amounts from those accounts are placed next to them. And then using our best judgment based on prior periods, based on credit policy, based on industry averages, overall economy, we develop a reasonable estimate of the amount of uncollectible accounts within each age group. All right, so this is a rather complex problem, and it's going to begin with preparing a summary journal entry for the monthly accrual of bad debt. Remember, throughout the year, each month, an accrual is made for bad debt. When you say a summary, that means instead of having 12 entries, we're going to summarize those 12 entries in one entry. So each month, we're going to be estimating the bad debt expense, so we're going to be increasing the bad debt expense, and the corresponding credit will be to our allowance account. The total throughout the year was the amount of the credit sales, $3,800,000, times our bad debt percentage of 2%. So during the year, we accrued bad debt expense of $76,000 and increased the allowance for uncollectible accounts to $76,000. During the year, we also had write-offs. When we have a write-off of an account, obviously we're going to reduce that customer's accounts receivables. So accounts receivables were reduced by $82,000. So individual accounts are written down to 0, most of the way down, and the total of accounts receivable reduced by $82,000. Now, we've already recognized bad debt expense in association with these accounts, either in the current year or in prior years. We do not have a loss on bad debt. Instead, what we're going to do is reduce down the allowance for uncollectible accounts. If an account can be identified as being bad, the individual account is written down, and then we reduce down our allowance. That is our entry for when we have an actual write-off. We write off the individual customer account, that reduces the accounts receivable, and we reduce down the allowance for doubtful accounts. Next, let's complete our aging table. Remember, the estimated allowance is going to be the amount in the age group times our judgment on the uncollectible amount. So we'll take group balance, multiply it by a bad debt percentage, copy, and paste that down for each of our groups, and then we can sum up our aging groups. So we estimate that we should have a balance in our allowance for uncollectible accounts of $104,700. Now let's do an analysis of our allowance account. Right, our beginning balance is given. We're told that our credit balance was 106,000. We're going to add the monthly accruals to the allowance. We're going to subtract out the write-off, and our balance before applying the adjustment for the aging is going to be 100,000. Alright, so we have a balance of 100,000. We've determined that the balance should be 104,700. So we are going to have to make an adjustment. We have to bring that balance up from 100,000 to 104,700. How much are we going to have to raise upon? Well, the required balance minus the current balance in our account. The accounts that are going to be affected are the same as our monthly accruals. We're going to recognize additional bad debt expense. We're going to increase the allowance for uncollectible accounts by the 4,700. The last piece deals with our presentation on the financial statements. The total bad debt expense for the year is going to be our monthly accruals plus our adjustment, two debits to the bad debt expense. And on our income statement, we're going to report bad debt expense of 80,700. Our accounts receivable balance will be the gross accounts receivable, which is 1,223,000 minus our ending balance in the allowance for doubtful accounts, which is going to be 104,700. Net realizable accounts receivable will be 1,118,200, just as it's written there.